You ask an AI assistant to summarize an email, and it takes about 2 seconds. That feels free. It isn't. But the real reason it isn't free is far stranger than a subscription fee. Behind that 2-second answer sits a machine the size of several football fields, drawing enough electricity to power a small city, built with hardware that will be obsolete before you finish reading this sentence. And increasingly, that machine wasn't paid for with cash. It was paid for with debt. Debt that doesn't show up where you'd expect to find it. Here's the strange part. The biggest companies in the world, the ones with more cash sitting in the bank than most countries have in their treasuries, are still borrowing at a pace that would alarm a small business owner. Not because they're short on money, because the AI build-out has become so enormous, so fast, that even trillion-dollar balance sheets can't fund it alone. So they lease, they issue bonds, they sign contracts for data centers that don't even exist yet, agreements to pay for computing power years before a single chip is plugged in. And under standard accounting rules, many of those commitments don't have to appear on the balance sheet until the lease actually activates. Which means the debt is real, the obligation is real, but on paper, for a while, it's almost invisible. Investor Michael Burry, who became known for correctly betting against the housing market before the 2008 crash, has spent much of this year pointing at exactly this. He's flagged that the 5 largest hyperscale cloud companies are sitting on hundreds of billions of dollars in signed data center commitments that haven't yet hit their books. He's argued that figure is larger than the debt those same companies already carry openly. And he's raised a specific concern about depreciation, the accounting method companies use to spread the cost of expensive equipment over the years they expect to use it. If a company assumes its AI chips will stay useful for 6 years, the yearly cost on paper looks small. If those chips are actually obsolete in 2 or 3, because the next generation is faster and cheaper to run, the real cost is being understated every single quarter. Burry's argument is that this is happening across the industry right now, and that it's making today's profits look healthier than the underlying economics actually support. To picture how large the numbers involved actually are, consider that the handful of companies building the biggest AI data centers have raised well over $200 billion through a combination of debt and new stock issuance in a single year, while planning to spend hundreds of billions more before that same year is even finished. That's not unusual spending for one product line or one division. That's closer to the size of a national infrastructure project, except it's being financed the way a company finances anything else, through leases, bonds, and the confident assumption that revenue will eventually catch up to the bill. And for a while, the market has rewarded that confidence. Chip company stock prices have soared, in some cases rising several 100% in little more than a year. Companies that make cooling systems and backup power generators for data centers have seen their share prices climb sharply too, riding the same wave. When something is rising that quickly, it becomes very hard for anyone involved, from company executives to individual investors, to imagine a version of the future where it stops. None of this means a crash is guaranteed. NVIDIA has continued beating earnings expectations even as warnings like this get louder, and being early to a concern is not the same as being right about timing. Burry himself was early once before and paid for it before he was eventually proven correct. But the structural question he's asking isn't really about one company or one stock. It's a much older question, one that economist Hyman Minsky spent his career trying to answer. What happens to a financial system after a long period of stability and success? Minsky's answer, in short, is that stability breeds the conditions for instability. When something has worked for a long time, when investment keeps paying off and confidence keeps growing, the incentive to take on more risk quietly increases. Lenders relax their standards. Borrowers stretch further than they normally would. Nobody sets out to build something fragile. It happens gradually, one reasonable-sounding decision at a time, until the system is carrying more risk than anyone individually intended. Minsky described this process in 3 rough stages. First comes what he called hedge financing, where borrowers can comfortably cover both the interest and the principal on what they owe using their regular income. That's the safe, boring stage, the one nobody worries about. Then comes speculative financing, where borrowers can cover the interest, but only by continuously rolling over or refinancing the underlying debt, betting that conditions will stay favorable long enough to eventually pay it down. And finally comes what he called Ponzi financing, not fraud in the criminal sense, but a structure where the only way to keep servicing the debt is for the value of the underlying asset to keep rising. At that stage, the system isn't being sustained by cash flow anymore. It's being sustained by faith. Nobody is claiming the entire AI industry has reached that third stage. But the questions Minsky's framework forces you to ask are the right ones. Is this spending being covered by revenue that already exists, or by revenue that's expected to exist eventually, once the technology fully arrives? And how much of the current stock market enthusiasm is actually pricing in that eventual revenue versus simply extending the story a little further because it has worked so far? That's not a story about technology. It's a story about psychology, dressed up in spreadsheets. And it's why economist Robert Shiller, who has spent decades studying financial bubbles, argues that markets move as much on narrative as on numbers. A story that spreads widely enough, repeated by enough smart, credentialed people, starts to function like a fact, whether or not the underlying math has caught up yet. Right now, the AI narrative is one of the most powerful stories markets have seen in decades. Reports from Apollo Global Management have found that the overwhelming majority of new venture capital funding this year is tied to AI in some way, a concentration higher than what internet companies represented at the peak of the dot-com bubble in 1999. A meaningful share of new corporate bond issuance, both investment grade and high yield, is linked to AI as well. Here's the twist that makes this uncomfortable rather than simply interesting. The story doesn't need to be wrong for the debt to be dangerous. AI might genuinely transform how the world works. The technology could be exactly as important as its biggest believers claim, and the financing behind it could still be fragile, because those are two separate questions. One is about whether the destination is real. The other is about whether the road built to get there can hold the weight being placed on it. Think about what happens if just one or two of the largest cloud companies decide to slow their spending, even modestly. Because so much of the industry is now financially tied together, chip makers selling to cloud companies, equipment makers selling to chip makers, power companies building generators for data centers, a pullback in one place doesn't stay contained. Burry has described this as a kind of bullwhip effect, where a small, rational adjustment at the top of the chain turns into a much larger shock by the time it reaches the bottom. It's the same dynamic that turned a housing slowdown into a global financial crisis in 2008. Not because housing itself was worthless, but because so much of the financial system had quietly built itself around the assumption that housing prices would keep rising forever. You don't have $300 billion in data center leases, but you might recognize the shape of what's happening because it's the same shape your own financial life can take without you noticing. Buy now, pay later. Services didn't exist in most people's lives a decade ago. Now they're used for airline tickets and increasingly for groceries. Each individual purchase feels manageable. $40 split into 4 payments doesn't feel like debt, it feels like convenience. But stack enough of those invisible, off-the-radar commitments together, spread across enough subscriptions, enough small loans, enough pay-it-off-later purchases, and you can end up carrying real financial risk that never once showed up as a single, alarming number. It arrives in fragments. It's real, but for a while, it's almost invisible, the exact same phrase used to describe the hyperscalers' unbooked leases. Think about your own version of hedge, speculative, and Ponzi financing, the same 3 stages Minsky mapped out for entire economies. Paying off your credit card balance in full every month is hedge financing, comfortable and boring. Carrying a balance but managing the minimum payments is speculative financing, sustainable as long as nothing changes. And relying on a raise that hasn't happened yet, or a bonus you're only hoping arrives just to keep your current monthly commitments afloat, starts to resemble the third stage, the one sustained by faith rather than cash flow. Most people never consciously choose to move from one stage to the next. They drift there, one convenient decision at a time, the same way an entire industry can. That's the mirror worth sitting with. The story you tell yourself about your own spending, that it's manageable, that it's temporary, that you'll catch up next month, is not so different from the story an entire industry is currently telling itself about its financing. Confidence that things have worked before is often the exact ingredient that allows risk to quietly build, not recklessness, not stupidity, just steady, reasonable-sounding decisions, made one at a time by people who all believed the story would keep holding. None of this means panic is the right response, for a household or for the market. Diversification is genuinely happening inside the AI industry. Enterprise and government demand for AI tools is growing in ways that reduce reliance on any single customer. Some of the companies building this infrastructure have real, profitable businesses outside of AI entirely. The presence of debt doesn't automatically mean the debt is unsustainable. What it means is that the difference between a boom and a bubble often isn't visible until after the fact, and the only real defense, whether you're a hyperscale cloud company or a household with 3 subscriptions on autopay, is the same one. Know exactly what you owe, not just what you feel like you owe. So the next time you ask an AI assistant to summarize an email and the answer appears in 2 effortless seconds, it's worth remembering what's actually sitting underneath that convenience. Billions of dollars in commitments that don't show up where you'd expect to find them. A financial structure built quarter after quarter on the confident belief that the story will keep holding. The same belief that shapes far smaller decisions made by far smaller wallets every single day. The technology might be exactly as transformative as it promises to be. Whether the debt behind it is sustainable is a separate question, and it's one that markets, much like people, tend not to ask honestly until it's already too late to answer comfortably.